Did you know that 62% of the adult population in the United States of America currently holds stocks? That means that 162 million Americans can be classified as investors. And all of these investors will, of course, prefer different strategies. Because if, for example, you're younger, you may have a higher risk tolerance and you will be willing to be more exposed to market fluctuations. Whereas, if you're closer to your retirement age, you may be more inclined to invest in dividend stocks and to just preserve the capital you have built up over your lifetime. Today we'll be comparing the three most common investing strategies in the stock market, which are value investing, growth investing, and dividend investing. I would comfortably say that value investing is the most common investing method in the stock market, and it's the method that most of the great investors actually followed. In order to follow this method, you first have to calculate the fair or the intrinsic value of the company. Once you have this fair value, usually investors apply a margin of safety to their calculation, which is usually between 15 to 20%. This is to hedge their calculation just in case they've used any wrong numbers or they're being too aggressive with their assumptions. This then gives them their entry price. And now the principle of value investing is to buy the stock whenever it dips below the entry price and then sell it when it rises above the fair value. As you can see in the graph, you're buying every time the price is below the dotted line, which is the entry price, and then you're selling every time the stock actually rises above its fair value. This can be explained by the quote below by Howard Marks, where he says that there is only one intelligent form of investing, which is figuring out what something's worth and see if you can buy it at or below that price. It's all about value. The next method is growth investing, where the majority of your time is going to be invested into analyzing the company. You'll want to figure out whether they can sustain their earnings growth, whether they're in a stable financial position, and you're going to spend so much time researching all of this because this is the method where you will probably have the longest holding period. So you want to make sure that you're buying into something decent. This method plays with what Warren Buffett always said, that it's not about timing the market, that it's about the time you spend in the market. In this investing approach, you'll normally be buying stocks which are trading at high valuations due to the fact that they have high growth rates. And you will want to be buying the dip on every occasion that you can in order to dollar cost average, which is reducing your average cost of your position to, in the long term, increase your performance in the stock. Now, this is the method that has the highest potential gain, but it also has the highest potential loss. And I think that the perfect way to explain why a lot of investors actually prefer this approach is explained by Peter Lynch when he said, maybe you're right 5 or 6 times out of 10. But if your winners go up 4 or 10 or 20-fold, it makes up for the ones where you lost 50, 75, or 100%. And last but not least, we have dividend investing. What this consists of is to buy and accumulate dividend-paying stocks. Once you get this dividend, you have two options. You can reinvest it back into the stock in order to start the snowball effect, or you can take that dividend and keep it to yourself to potentially live off that income or invest it elsewhere. The price of these stocks generally does not move much. Some examples may be Johnson & Johnson, Coca-Cola, 3M, or those huge established companies that have been in the market for a very long time. Now, even though they may not rise up a lot in terms of stock price, all their dividends will accumulate, and in the end, you may actually come up with a very good performance. As Benjamin Graham stated, the stockholder wants both income and appreciation, but in general, the more he gets of one, the less he realizes of the other. So this is a table comparing the three strategies. In terms of investment horizon, I believe that value stocks are the ones you hold for the shortest time period. This is because dividend stock holders do not care so much about the performance of the stock, they're focusing on the income they get, and because of growth stock holders are not focusing on short-term volatility, they're more focused on the fundamentals of their companies in the long term. Growth stocks obviously have the highest risk level, and dividend stocks have the lowest ones because they have the lowest volatility. In terms of valuation, when you're using the value investment approach, you want to look for companies that are undervalued and trading lower than that intrinsic value you calculated. When you're looking at growth stocks, chances are you will probably be buying stocks that appear overvalued because they have extremely high growth rates. And then when you're buying dividend stocks, you potentially want to find them undervalued, but since they're not very volatile, chances are you will mostly trade them at fair fair value. But this of course relates to their growth potential. Value stocks have medium growth potential, growth stocks have the highest growth potential, and dividend stocks have the lowest growth potential among all the options. This again may be related to their market cap, because for value stocks and for dividend stocks, you're trading mostly mid to large cap stocks, whereas with growth stocks, you can find them anywhere. I have a lot of examples from small biopharmaceutical companies to large cap companies such as Netflix or Nvidia, which still have impressive growth rates. And now finally, do they pay dividends? Dividend stocks will always pay dividends. Value stocks may sometimes pay dividends, normally they will. And in terms of growth stocks, they usually do not pay dividends because they're investing all that free cash flow they generate back into the business. This is the case again with all these high growth rate companies. Now, depending on the strategy you choose, you will be focusing on different metrics. For example, if you're choosing value stocks, you will mainly be focusing on valuation ratios, such as the historic price to earnings, the free cash flow yield, or other similar KPIs. If you're focusing on the growth investing strategy, you will focus on return on capital employed, margins, earnings growth, interest coverage ratio, more of the ratios that we normally look at in this channel. And if you're looking at dividend stocks, you will normally be looking at the historical dividend yield, the payout ratio, how much the dividend has been increased year after year, and all of those kind of ratios. But which of these methods is actually better than the other? Well, here you can see the 3-year performance comparison for 3 funds. All these 3 funds are by Vanguard, and the first one, VUG, is for growth stocks, the second one, VTV, is for value stocks, and the third one, VYM, is for dividend stocks. As you can see, VUG has the highest risk and volatility. In these 3 years, it outperformed the other funds. However, at some point, it was down close to 30%, while the other 2 funds were slightly positive over the same time period. As Fidelity says, value stocks and dividend stocks have more limited upside potential and therefore can be safer investments than growth stocks. But if we move further out and we look at the 5-year performance comparison, we can see that VUG is the clear outperformer when comparing to the other 2 approaches. So I'm going to zoom out even further. We're going to go to the 10-year performance comparison. And what happens is that VUG outperforms even further. The longer time frame you give to this approach, the more outperformance you will gain, because this approach is all about a longer time horizon. So what is my investing strategy? Well, I define myself as a growth investor. However, I believe that you can combine strategies within your portfolio as long as you know what you're doing. And that is my case with investing, because in my same portfolio, I have companies such as Crocs, which I consider a value play, because I bought the company when I believed it was trading at a super cheap valuation, and I've been adding on the different dips that I found. Now, I know that this is not a fast growing company because it grows its revenue at around 4 to 5% every year. However, I have plans on selling the position when it pays out all of its debt and it starts repurchasing stock. And in the same portfolio, I also have Lantheus Holdings, which is clearly a growth play. This company is growing at a super fast pace. It has extremely solid fundamentals, a high return on capital employed, solid interest coverage ratios, and at some point I was actually up on this stock around 117%. Of course, it has fallen since then, but this just to show you that you can combine strategies as long as you can sleep well at night. So thank you so much for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.